Ignoring weekly time frame analysis could cost you big losses. In this video, I will show you 3 specific cases when weekly time frame beats daily time frame analysis. Please don't forget to like this video, subscribe to my YouTube channel, and learn the situations when weekly chart exposes what daily chart can't. When the market is trading in a strong bullish or bearish trend and trades beyond the recent historic levels, quite often daily time frame will not be sufficient for the analysis and identification of significant supports and resistances. That's the case on the Euro-Aussie pair. You can see that the market is trading in a strong bullish trend, and at the moment the price is setting a new higher high. Analyzing the historic price action and looking for the next strong resistance, you can see that we don't have any historic resistance on the left on a daily. The proven way to identify the next meaningful levels will be to analyze a weekly chart. But if we switch to a weekly chart, we can easily find the historic resistance that the price formed 5 years ago. You can see that weekly time frame provided a completely different perspective, and we easily found the next potentially significant resistance. Weekly time frame analysis is important not only for the search of historic levels. It can help you find significant vertical structures, the trend lines. Examine euro-dollar price chart on a daily time frame. Analyzing the historic price action, we can easily identify multiple significant supports and resistances on a daily. You can see that we have a lot of historic structures and we can easily recognize them. But weekly time frame analysis may reveal the structures that you cannot find on a daily. If we open a weekly time frame and zoom out the chart and analyze the price action for the last 2 decades, we can spot a very peculiar trend line. Let's take that high of 2011. If we draw a falling trend line, we can see a very significant falling trend line, a significant vertical resistance that the market is respecting for many years. And definitely after its test, we may expect a strong bearish reaction to that. And obviously with the daily time frame analysis, we would not spot that trend line. Some false support and resistance breakouts that you see on a daily time frame could easily be avoided with the weekly time frame analysis. Quite often a daily time frame support or resistance is in fact a weekly structure. And for its breakout, a weekly candle close will provide a more accurate confirmation. Look at that significant resistance on Aussie dollar pair on a daily time frame. With a strong bullish movement, a daily candle closed above that resistance, and according to the rules, it means that that resistance is broken. It is now broken, and after the breakout, it should turn into a strong support from where the next strong bullish movement should follow. However, instead the breakout turned out to be false, and you can see that a strong bearish movement followed. But that breakout could be easily avoided taking into consideration a weekly time frame analysis. You can see that the resistance that we spotted on a daily time frame is in fact a weekly resistance, and in order to confirm its violation and its breakout, a weekly candle should have closed above that. Instead, you can see that though the wicks of these weekly candles went above that resistance was respected, and from that a bearish movement followed. Do not ignore and always check a weekly time frame. It shows a unique perspective on the market and reveals a lot of hidden elements that you would miss. No matter whether you are a scalper, day trader, or swing trader, remember that weekly time frame structures are very impactful and accumulate large trading volumes. Let me know, traders, in the comment section if you have any questions. Also, traders, learn how to trade, watch how I trade live in my trading academy. For more info, check the link in the description below. Also, traders, please watch my other videos.